All right, well, welcome everybody. I'm so glad you could join us today with Bob Dahl and take a little time to hear his 10 predictions for 2022. But before we jump in, we actually have President Reichen with us to do a brief intro of Bob. So President Reichen, I'll turn it over to you.
Yeah, I really appreciate the work of the Center for Faith and Innovation. And this is, I think, typical of CFI in bringing you first-rate, world-class content. You'll hear Bob Dahl in one of his sweet spots, which is financial forecasting. I have the privilege of knowing Bob in other contexts as a colleague, as a friend, as a coworker. He is also a really gifted church musician. He has a passion for theology and is well read in theology. He has a real passion for God's work in global cities, and that's evident through some of his affiliations. And we have what is absolutely a pleasure of working together on the board for the Lausanne movement, which Bob is chairing, having chaired before, and is chairing again. Just does such a deft job of blending together a truly global board. We're usually meeting in about 10 different time zones when we meet. So this is somebody that has a heart for ministry and lives out his Christian faith beyond the business world, but also in the business world. So, and has been on campus and shared very personally about his faith walk in the business world as well. That was really memorable for students, faculty, and staff who were there as I was. So, Bob, thank you for being on this call, and welcome virtually back to Wheaton College.
Thank you, Drs. Reichen and Stolz. Thank you, Phil, for those kind words. And it is my privilege to, at this point, talk about my profession, despite all the good and important things Phil just said about living life. Yes, I'm going to talk about predictions for the economy and the financial markets, but as Dr. Reichen and I were kidding beforehand, am I a prophet or the son of a prophet? And of course, you know the answer to that question. Of course not. Only the God in heaven knows the future in all respects, including economies and markets. But I'm going to take a shot at it with the pea brain that I have and the experience I have, given where we are and where we're going. So I hope this is relevant to you in some way, shape, or form. For some of you, it might be rather basic. For others that are not closely associated with markets, some of it may be Greek, as they say. But here goes. Let me set the stage first. I've done these 10 predictions now for over 30 years, and I always try to have a theme that ties the predictions together. And the theme this year is that we are in a tug of war. That is the economy, and more specifically, the financial markets, and more specific than that, the stock market, between, on the one end of the rope, pulling hard, the tailwinds of economic and earnings growth. We have a good economy. But pulling equally hard in the other direction, and at least year to date a little harder, are the headwinds of valuation. Valuation simply is, how much should I pay for, yes, individual companies, but for the stock market as a whole? And while we have that tailwind, thanks to the largesse of money from Washington, D.C., more to say about that in a minute, we also have these headwinds. Now, if we go back to December when we issued these predictions, virtually everybody agreed with the tailwinds. Earnings are going to be okay, not as good as last year, but earnings growth will be good. And most observers prophesied that the stock market would go up with earnings. The S&P 500 is a good reference point for the market. It entered 2022 at around 4,800, and with earnings going up 8-ish%, the consensus was that the stock market would end this year at 5,100. Our view, that is the other end of the tug of war, is that valuation was not sustainable. With rising interest rates spurred by rising inflation, more about both in a minute, it is hard to argue that the price earnings ratio, the PE ratio, one standard measure of valuation for stocks could be sustained at roughly the 22 level where it was historically. If you know your stock market history, you know that kind of number is very much on the high end of observations. Stocks on average sell about 14, 15, 16 times earnings, sometimes single digit PE ratios, not that often above 20. You know, when interest rates and inflation are close to zero, a price earnings ratio over 20 probably makes sense, but not so much when we have these other forces. And that's what caused us to come into the year rather cautious. When I made these predictions in December, people called me a bear because our target for the S&P at the end of the year is 4,500, which implies a modest down year. As we speak, the S&P 500 is trading at 43.89. So we're expecting, you know, modest rise from here after the carnage for the first couple months, perpetuated by not only the inflation interest rate concerns, but of course the conflagration that we're witnessing between Russia and Ukraine. So tug of war. You know, maybe one way to put it is to say this is a year where the stock market is represented by, let's say, the Dow Jones Industrial Average will travel more points than any year in history and end up not going much anywhere. In other words, one day is up, the next day's down, and so on and so on. More about that and what to do about it as investors. So that's the overview. Let me take you quickly through these 10 predictions that hopefully are consistent with all I've said so far. The first prediction is that real growth, the broadest measure of economic growth in the US, real GDP, meaning after inflation, and inflation remain above trend, but decline from 2021 levels. So in other words, we're arguing that after an amazing economy in 2021, where the US economy grew the fastest rate since 1984, growing between 5.5% and 6%. That's very big number for an economy as big and mature as the United States. Our long-term growth is approximately 2%. So 5.5, 6 is a very big number. Now, where did that come from? I think it's important to understand that perspective. I referenced it earlier. Easy money. Some of us kidded that we might see a day when the central bank in the United States, the Federal Reserve, dropped money out of helicopters. And my line is they skipped the helicopters and went right to B-52 bombers. The amount of money the Fed has added to the system in lots of different ways, lots of different programs, has been gargantuan. We had an emergency. It was called COVID, and we didn't know how to spell it the first day. And as a result, the concern was we've got to rescue our economy lest we push it into some sort of deep recession or worse because the economy was shut down. Well, that took interest rates to zero on the part of the Fed, which may be appropriate for an emergency, because I'll come on to in a few minutes. The emergency is long since passed, and the Fed has not changed their policy, likely to in March. Lots of talk about that. The other source of strong economic growth was not to be outdone by the Fed. The Congress said, we're going to do our fair share. And of course, they passed bills totaling trillions of dollars of spending. And when that money finds its way out into the hinterlands, people spend some of it, and that pushes the economy higher. So we think real growth this year will be 3 point something. Remember, long-term growth 2, last year almost 6. And inflation will be less than last year, more about that in a minute, but still at a reasonably high level. Prediction number 2 is about inflation. My view is the most important point of view one needs to have a view on the capital markets this year is an opinion about inflation. And mine is, via prediction 2, that inflation will fall this year, but that core inflation will remain stuck between 3 and 4%. Now, inflation is a complicated concept. Remember, economics is the dismal science, so we can all pontificate all day long without much precision. My argument is, and we put a white paper out on this at Crossmark not that long ago, that there are three pieces to inflation. One is transitory. Now, as an aside, most of you probably know the Fed argued that the inflation pickup was all transitory. And our point in putting out that white paper last September is to say, no, no way. But there is a piece of it that's transitory, and that is coming out of the system. That's related to some comparisons, COVID related. I won't get into the technical details. The second part of inflation is related to supply shortages. You know, when you turn an economy off, never having done it before, and then you turn it back on, it doesn't free flow immediately. Not everything adjusts. And so we have a bunch of supply shortage issues that we are still dealing with. My guess is that we get a significant, call it half of those solved this year, in which case that part of inflation will recede. So two parts coming down. That's why we think the overall level will come down, but don't be fooled or be complacent. Core or structural inflation, embedded inflation, can I say it that way, is likely to remain with us for quite some time. We think that's the part that's going to stay between 3 and 4%. The goal of the Fed was, when that number was in the ones, is to get it up to 2. Boy, did they succeed. Be careful what you wish for. And we've gone to an inflation rate now, trailing 12 months, of 7% on the consumer price index, 7.5%, 6% core inflation. If you're not familiar with core inflation, it simply strips out energy and food, because of course no one listening to this call uses energy or food. All kidding aside, the purpose in that is energy and food inflation is very bumpy, and so to try to level things out, they have that secondary measure. Either way, 3 to 4 is what we're targeting for this year, which is a far cry from 2, where the central bank would like to see it. And if that's the case, that's my argument about these valuation headwinds. So a word or two about the Fed. The Fed has had lots of meetings and lots of communication that they are likely to move their pegged interest rate, which is currently 0 because of the emergency related to COVID, to begin raising that in March. Lots of debate about how far and how fast. Our view has been, remains, that they will do it 1/4 of a point at a time, and probably do about 4 increases this year to get the measure to 1. You know, if the Fed is as far behind in magnitude and time, my argument is kind of yesterday they should have moved rates to 1%, but they never move that way. They're a slow, gradual body. So that's the inflation story. It's an important one in my view. Prediction 3 has to do with the bond market. If you are an owner of a 10-year US Treasury bond, you lost money in 2021. We guess when this year is over, you will lose money in that instrument again, which would be the first back-to-back year since the 1950s that a 10-year Treasury investment lost money. And it has everything to do with the fact that interest rates are creeping higher. Yes, the federal funds rate, which is the very short end of the yield curve and out the yield curve. That's problematic. If rates go up because inflation has gone up, that creates problems for lots of people. Yes, it creates an opportunity. If you're a saver and you have your money in cash, you know you've gotten a near 0 return for some time. You're going to get a small return as those interest rates move somewhat higher. So positioning in the fixed income market, be careful about how long your maturities and durations are. Stay away from the Treasury curve. Try to own some corporates, some TIPS, some inflation protected securities, and some alternative investments that look like bonds but are not subject to rising interest rates. Prediction 4 is about the stock market. It reads, stocks experienced their first 10% correction since the pandemic and failed to make the gains widely expected. Now, I touched on both those pieces in my introduction. To repeat, the consensus was expecting stocks to go up with earnings. Not only is that not going to happen in our view because these valuation challenges, but of course we've had a 10% correction. thanks to the war being fought in the Ukraine with Russia's invasion. A couple words about it. Wars are obviously very serious issues, and our hearts and prayers go out to the Ukrainian people and all those we know who have relatives there. It's a tough environment. Assuming the nuclear word does not get mentioned too often and certainly not used, our view is that this war may continue for a while in sort of guerrilla format. Yes, we're watching carefully the price of oil, which has gone up a lot because the supply to some degree has been curtailed. The price of oil matters big time. Where you get your oil matters big time. Germany gets somewhere between a third and a half of its energy, about 30% of its oil and about 50% of its natural gas from Russia. And so you see the delicate nature of that, because that affects energy, and energy prices affect consumption, affect economies, and have reverberations all over the world. Perhaps in the Q&A, someone will ask some more about the oil question. So we've had that 10% correction, and our view is that the year will end with earnings in pretty good shape, but price earnings ratio or any measure of valuation being less than where we started the year for the reasons I articulated earlier, for 4,500 on the S&P plus or minus. Couple more words about the stock market and valuation. There's a correlation, as many of you know, between the rate of inflation and the price earnings ratio on the stock market, or the valuation of the market. In fact, I'm looking at a slide, how to use slides, that would now show you that when inflation runs between 3 and 4%, the PE ratio on the stock market in the US historically has been about 16 or 17, not 19 where we are, let alone 22 where we were. Curiously also, there's a relationship between how stocks do and the unemployment rate. When the unemployment rate is high, stocks do well. And when the unemployment rate is low, stocks on average do poorly. Sounds a little counterintuitive, but think about it. If the unemployment rate is high, the Fed and other officials seek to lower interest rates to fight that unemployment, and the stock market anticipates a better economy and goes up. Conversely, and where we are today, when the unemployment rate is low, people get concerned the Fed's going to take the punch bowl away, that is, take the free-flowing form of liquidity, and as a result, stocks tend not to do well, and that's in fact where we are. So the question is, if I'm an investor and I think the stock market's kind of going nowhere this year, how do I make my money? Well, for the last bunch of years, if you bought and held, you did just fine, because stocks generally went up absent the pandemic. Now we're in a position of stocks are going to be flat, that a buy and hold strategy will earn you nothing. It will not work this year. And therefore, one has to be a little more adroit. I'm not saying you have to be a day trader, but what I'm doing in my clients' portfolios is, when it's a lot of red on the screen and my stomach doesn't feel so good, and it looks like the world might end, parenthetically, even so, Lord Jesus, quickly come. That's a time when, if the Lord doesn't come, you should buy some stocks. And conversely, when there's a lot of green on the screen and it looks like we've solved the world's problems, and stocks are up for a period of time, let a little go. But prediction 5 is within the stock market, how do I make money? And it basically reads, cyclical, value, and small stocks outperform defensive, growth, and large stocks. Now, there are 3 pairs there, obviously. The first 2 have worked in spades already in these 2 months. For example, value stocks have done 10 percentage points, 1,000 basis points better than growth stocks, even since January 1st. That kind of performance is kind of what you get over a business cycle, typically, not just a 2-month period. And there are lots of reasons for that. Of the 3 pairs, the one that has not yet worked for us is big versus small. Big stocks are modestly less than 1% better than small stocks. We'll see how that pans out. I'll leave the details as to why on those pairs to questions if anybody has one. Prediction 6 is about sectors. It reads financials and energy stocks outperform utilities and communication services. It's only early March, but by far and away the best performing sector this year is energy. It's up more than 20% with every other sector down. Of course, that's related to the price of oil. Financials, despite being down, are the second best performer. So we're looking okay in the early going on this prediction. Why do we like financials? Financial stocks tend to do well when the economy is okay, when interest rates rise. They're pretty cheap. Their balance sheets are of much better quality today than they've been at this point in other economic cycles. Why do we like energy stocks? Energy is a supply and demand story. In fact, when President Biden on his first day in office canceled the pipeline, that caused me to run out and buy energy stocks because he took supply away. And if demand improves, which it did as the economy has recovered, and supply is constrained, the great equalizer is price, and it goes up in that sort of environment. And we guess that game is not over, although energy stocks are a bit overbought. We'd wait for pullbacks to do a lot more in that arena. Prediction 7, will international stocks ever outperform? Our 7th prediction is yes, international stocks outperform the US for only the second year of the last decade. The US is dominated. And the reason is the United States stock market is the most defensive in the world. We have more stable growth companies. We have more growth companies. And so our companies in our stock market tend to do reasonably well through thick and thin. When economies improve, which they are globally despite the war, we usually have a period when international stocks do better. That can be aided by the currency move. And our guess is after some strength in the dollar related to safe haven status because of the war, the US is likely to resume a downward movement in its currency. When countries run current account, trade, and budget deficits the size the United States is running, often their currencies are under pressure. So our view is if you've been fortunate enough to have all of your stock market investments in the US, stand up, take a bow, and do a little dollar cost averaging outside the US. We'll see how that pans out. Again, year to date, international stocks are doing 5%, 500 basis points better than the US, only because they've gone down less. Sad way to outperform. Prediction number 8, values-based investing continues to gain share. We are seeing a phenomenon in investing where investors of all stripes, individuals, institutions, all kinds of organizations are spending more time appropriately, in our view, lining up their investments with their values. That is excluding companies that are doing bad and emphasizing companies that are doing good. And the Q&A, I'm happy to amplify on that, but we're seeing that. And now we have lots of evidence that investing in values-based portfolios is no give up in return. 10, 20 years ago, if someone asked how much I have to give up to do that, we really didn't know. But now we have enough empirical evidence to say you don't give up anything. In fact, I'm staring at a 20-year chart off to my left here that shows the performance of the Standard & Poor's 500 and a biblically responsible screen portfolio, and they have virtually identical returns. So who wouldn't want to line up their investments with the rest of their life? Number 9, I think the question I get asked most often, even more so by Christians than people of other faiths or not of faith, is what about the debt and the deficits of the United States? And my argument is, yes, there is no free lunch and we are borrowing from the future. But, prediction 9, after a 60-year low in 2021, federal interest expense as a percentage of revenue begins a long-term move higher. Now, that sounds rather arcane, so let me explain. If you look at the amount of interest that the stock market that the federal government pays on the debt, it is at a 60-year low as a percentage of revenues. And somebody says, don't you have that upside down? No, not at all. interest rates until recently have fallen faster than the debt has gone up, such that interest expense has tailed off. Rather weird sort of analysis, but that's the truth. Sadly, as interest rates rise and the debt continues to accumulate, I think this prediction is like shooting fish in a barrel. We will circle debt as a percentage of revenues for 2021, and that's probably going to be the low of our lifetimes. And if we take even the Congressional Budget Office guesstimate about debt levels, and as they go higher, that becomes even more evident. Prediction 10 over the years has always been some sort of observation about an election or Washington, D.C. Obviously, this is a year of midterm elections, and our prediction is, because these things do affect markets, Republicans gain at least 20 to 25 seats in the House of Representatives and narrowly win the Senate. I can give you the whys and the wherefores, and maybe that'll come up in the questions, but let me make a couple of market observations, if in fact this prediction is accurate. If it is, it means President Biden's economic agenda has but a couple of more months to go. Soon, certainly by July 4th, we will move to all focus in DC on the election, and not much gets done. So a couple of more months. The war in the Ukraine has reduced the probability of even a small Build Back Better package. And so our guess is not much more to come from the Biden agenda. And then we won't see anything significant of economic legislation until the 2024 presidential election. Why does this matter to markets? Well, if you look at the 4 years of the presidential cycle, year 2, the year we're in, is typically the year of the biggest drawdown. In other words, from the high to the low during the year, a 19% drop. In the other years, it's 11-ish%. Also, if you know your stock market history, you know the Standard & Poor's 500 was established in 1926. Since then, the stock market has been up 73% of the years. So if somebody asks you, how do you think the stock market's going to do in a particular year on January 1st? You say, I think it's going to go up, even if you know nothing, and there's 3 chances out of 4 you're going to get it right. But if you look at midterm election years, in those years, the stock market is only up 62% of the time. And then if you further look at midterm election years in the first term of a president, which of course is the case with President Biden, in those years, the stock market is only up 44% of the time. So in other words, it's down more often than it's up. This is one of many factors that caused us to come into the year with a little more concern. Now, to end this prediction on a good note, since 1950, from the midterm election day out 12 months, the stock market has always been higher. No down moves in that 12-month period. Let's hope we don't break that chain this coming time. So let me start to wrap this up with a few conclusions and longer term observations, and then we'll move to questions. Conclusions. The Fed is no longer our best friend. Every business cycle, the Central Bank of the United States oscillates between being our best friend and our worst enemy. They have been our best friend for some time. And now, as they take the punch bowl away, they become our enemy, and that's the valuation concern. 2, inflation, watch it with an eagle's eye, likely to recede, but not go back to acceptable levels. 3, consumers, I didn't cover this at all, have $2 to $2.5 trillion of excess savings on their balance sheets. They will spend some of that money, probably more of it in this coming period as the economy reopens, more on services and experiences and less on goods. Number 4, earnings are likely to be good. 5, valuation levels have come in some, but they're still challenged. 6, international economies are beginning to do better. 7, China. I haven't talked about China. China has made it clear in public and private forums that they intend to become number 1 in the world economically, technologically, and militarily. That's a big challenge for the US and the Cold War. Yes, we have one with Russia, but we have a longer and, in my opinion, more serious one with China. 8, commodity prices. Bias is up, but they're up a lot. So I'd say sidewise and volatile as the stock market. 9, I haven't mentioned COVID, other than to say, my view, I'm not a virologist or anything like that, but having read so much on this and talked to people, I think COVID's here to stay, but we are learning and we'll learn to live with it. Finally, number 10, long-term returns in financial markets are likely to be far more subdued than they've been in the last 40 years. We've had a 40-year bull market in bonds. Interest rates have come down from double-digit levels to, they got down to 0.5% of the height of the pandemic. And they're starting to move in the other direction. And that's a challenge to this massive rise in valuation for the stock market. And on top of that, corporate profit margins are at all-time highs. Unless you're going to make the argument to go on higher, those 3 facts tied together means returns are likely to be far more muted, maybe half of what we've seen before. Let me conclude with just reading a list of what to expect over the next 10 years. Some of this is tongue in cheek, but maybe it'll spur a question or two. 1, much more modest returns, as I mentioned. 2, a recession. We'll get one in the next 10 years. 3, older population. We now have more grandparents in the world than we have grandchildren. World population growth is nearly 100% in people 65 and older. In other words, the population of the globe less than 65 is about static. Sadly, we now have more obese children in the world than underweight children. First time in history. Number 4, technological innovation, information, healthcare, energy, manufacturing. It's a big productivity enhancement, and that's a good tailwind for our and the global economy. 5, robots and automation will continue to threaten jobs. 6, smartphone turns into smart everything. Perhaps that's happened already. 7, space tourism. Go buy a ticket. 8, globalization is slowly being replaced by more isolationism, protectionism, and populism. 9, the US-China Cold War. And number 10, cyber warfare is going to become a staple, sadly. So Hannah, let me stop there and turn it back to you and questions. I hope this has been helpful.
Yeah, this has been great, Bob. Thank you so much. How many years have you been doing these predictions? My team told me that you're fairly accurate. So
a little over 30, and the grader that we have looking at them all the time, I think we have a 72% accuracy rate. The problem is, Hannah, coming into the year, we never know which 7 we're going to get right, which 3 we're going to get wrong. If we knew that, we could make a fortune.
Okay, well, I took notes, so we'll see if the 70% I took are really going to help me out. So thank you, Bob. I have a question. We had a lot of questions coming in the chat, so we'll start kind of moving through some of those. But as a logistics and supply chain professor, I'd really like to ask about Biden's recent State of the Union speech. We had a couple other questions about Biden's recent speech. He definitely early on seemed to indicate that a lot of inflation was tied to supply chain. And I'd be interested in, what you heard and what caught your attention in the State of the Union address that Biden just gave, that could give us some indicators in terms of inflation and supply chains in that space.
Yeah, he certainly did, in my opinion, put more weight on the supply chain being the cause of inflation that I think is going to bear out over time. I hope he's right and I'm wrong, but somebody said, well, tell me about this core or embedded inflation, and I say go to the supermarket, go fill up your car with gasoline, go buy a new car, go try to rent a car, go buy a home, go rent an apartment. I mean, these things are. We have 3 kids. Our middle child's looking for a home in the suburbs of Philadelphia. They've bid on 3 homes within the last month. And in each case, they bid a substantial amount above the asking price. And in all 3 cases, they didn't get it. There's a huge demand out there. And in some places, there are supply shortages, for example, in this area. So supply shortage is definitely part of the reason inflation is likely to fall this year, but I don't think it's going back to an acceptable level anytime soon.
Yeah, thank you. So for everybody that didn't see my comment in the chat, if you want to put any questions that you have for Bob in the chat, we'll work through some of those questions now. So please feel free to add questions in the chat. I well, I'll ask one more political question and then we'll kind of shift to general market kind of questions. If you compare, really only 2 years of Biden compared to the Trump administration, can you say over the last 2 years in comparison what has worked and maybe what hasn't in terms of economic change or maybe stagnation?
Yeah, I mean, obviously COVID makes obscure a lot of the good and accurate observations one might make to that question. It's made it very difficult, both for Trump in his toward the end and President Biden in his early years. I guess one of the things I think has been missed that was hugely successful under Donald Trump was we were beginning to change income levels between the highest and the lowest. We had 2 years in a row. It ended right before the pandemic with 19 and 18 and 19. The wages of the lowest decile of earners went up much faster than the highest decile of earners. So we're beginning to do what many of us would like to see happen naturally and economically, as opposed to legislatively. And I think the source of that was we were beginning to witness some stronger growth, or sometimes you hear it said this way: if we could only grow the pie faster, the individual pieces are easier to manage than if the pie is rather stagnant. So I'd say that's one item that we missed. I would criticize both administrations for spending way too much money. Now, it's easy for me to play Monday morning quarterback. They didn't know how bad would COVID get, et cetera. So I get that, but I think we could have waited a little longer to see the effects of the first trillion or two before we had to spend another trillion or two. And I'm not laying that blame at either party. I think both parties are to blame. We've put on almost $10 trillion of debt here in the last couple of years that, for our kids and grandkids is going to settle us.
Yeah, thank you. And I have a question here from Eric Vandenberg at Ron Blue that kind of shifts us a little bit. And Eric has two questions. His first is, what is your opinion on the 210 spread and the tightening that we've seen recently?
Yeah, so the interest rates would move higher is no surprise for all the reasons I hope I've articulated. That we've seen the shorter end of the curve move up in yield more than out the curve, which has caused some of this tightness, is a little bit of a surprise to me. I think what the market is saying is Fed's going to raise rates, and therefore that part of the curve needs to move up in yield. But you know what? Long term, we really don't have a whole lot to worry about. And so those rates have remained stubbornly, can I say, low. I think the short end has it right. And look, the market's far smarter than I am. But if I were to quibble with it or challenge it, I don't think if inflation is going to stay at 3 or 4, that we're going to keep 10-year, 30-year treasury yields anywhere close to 2%. Those yields will go higher. But maybe I'm wrong and inflation is transitory and it's going to back out. And then, life will be a whole lot easier for everybody and the markets will do better.
Yeah, well, speaking about life being easier and getting better for everybody, Eric's second question is about the biblically responsible investing and the values-based investing. And his question was on not investing in bad companies compared to, making your voice heard at stake shareholder meetings. And are we seeing any, a shift or maybe even a swap in that story that, before you had to convince everybody to invest in the good companies, can we make a case that you're worse off if you invest in bad ones?
Yeah, so the empirical evidence of just taking a basket of, quote, bad companies it is about the same as being neutral and the same on the good side. But that's different for a lot of people's thinking were 5, 10, 20 years ago, where you must pay a price to do this. I mean, if you can invest in, name 3 industries that are not good industries, you're limiting your investment alternatives and choices. Therefore, you're giving something up. And the truth is that's not been the case. I think what Eric's referring to in the common parlance in the industry is avoid embrace, and engage. So avoid is to say these companies, I'll put it in biblical terms, these companies are against what God wants. And then the embrace is to say, can I give a kiss to the companies that are doing good, promoting justice, promoting family values, treating their employees, their community, their environment well. And that's the fun part of investing. That's what I do for a living, exclude the bad, accentuate the good. And then the engage, and he alluded to that in his question, is proxy voting, calling the company up, showing up at a shareholder meeting, and our part of the industry is doing more and more of that to try to have a voice that is heard. Of course, it begs a question: what you decide might be bad, I might say is neutral, and vice versa. And we could get into long discussions, debates, arguments on those issues. And my view is let's focus on the forest. Let's don't get so hung up on the trees that we disable our ability to make a difference, and we stymie ourselves.
That makes sense. Yeah, thank you. In your prediction number 7, you talked about international markets and a little bit about the U.S. dollar and U.S. currency. And we have a question from Mark Phillips about cryptocurrencies. And have you seen a meaningful impact of cryptocurrencies? Whether including like central bank digital currencies or anything else. Have you seen any shift in that space?
Yeah, so in my view, it's still early days. Let me explain. Well, first thing that comes to mind is, I don't know, 6-8 years ago, I've forgotten how long it's been. I remember my son calling me, Hannah, and say, "Dad, do you own Bitcoin?" I said, "What's a Bitcoin?" I'd never heard of it. And of course, I now know enough about all these things to be dangerous. But my view is cryptocurrency is a legitimate technology. Blockchain is a legitimate technology. But it's too early to know who the winners and losers are. The governments haven't decided how are they going to get involved, how they're going to regulate this. So I think there's a future here, but it's too early to know. So to me, it's still speculation. And I saw an article recently that as of December 31st, with of course a lot of these things seemingly going straight up, only 30% of the owners owned their cryptocurrencies at a profit, 70% at a loss. There is so much gambling and speculation taking here that I have said in my investment career, if I can't get my arms around it, if I don't understand it enough, I let somebody else make or lose fortunes. And that's where I am, studying it hard, believing there's a future, but waiting for some more definition.
So in the longer term planning then, we have a question from John. If you're concerned about bond and stock returns in the short term, do you have alternative investments that you like, for thinking of longer term planning?
Yeah, so my caution is mainly around this year. I think 5 years from now, stocks will be higher than where they are today, but that the rate of appreciation is going to be, pick a number, half of what it was. Stocks and bonds have had enormous returns over the last 10, 20, 30, 40-year period, with some interruptions along the way, clearly. And it is about to repeat, unless you can argue for lower interest rates, they're near all-time lows, unless you can argue for higher PE ratios, they're near all-time highs, unless you can argue for higher profit margins than they are at all-time highs, it's really hard to argue we're going to have a head of steam and have great returns going forward. So that doesn't say I don't want to own stocks and bonds. I just have to lower my expectations because most other things don't have superior returns to that either. In other words, the whole return structures come down. But begging back to the question, yeah, I'd have some alternatives in my portfolio. For example, a great alternative to treasury bonds are equity market neutral funds. Equity market neutral funds are beta zero. The one I manage is 100 stocks long and 100 stocks short. And, on up days, you hope your longs go up more than your shorts, and down days, the shorts go down more than the longs. Equity market neutral funds have bond-like returns, bond-like volatility, but no interest rate sensitivity. Now, there are other traditional alternatives. Real estate's one, treasury protected, inflation protected securities, Some argue that's a fixed income instrument. Some say alternatives. So yeah, I would have an open mind and look at some of those, not blindly. As hard as it is to analyze and choose equity and fixed income investments, either individual securities or mutual funds, it is even harder in the alternative world. It's more complicated.
Absolutely. So I want to ask you an even more complicated question then about the global markets. When we talk about, we've talked about China a lot. And so when we think about, what's going to happen globally, which global city should we be watching in the world's market? Is it China? Is that the country we should be watching at this point?
So did you say which city or which country?
Well, which country? We'll go for country.
Yeah. Look, China, without question, its size, its growth, its ambition, all say you've got to pay a ton of attention to China. Now, it's not like they don't have issues. For example, many know that they had a one birth policy for quite some time. That may have solved some short-term problems, but is creating immense long-term problems. China's growth rate will slow significantly. Their population is shrinking. I say that and recognize there are other places in the world, more developed areas, Japan, parts of Europe, where the population is shrinking. And any economists out in listening know that the long-term growth rate of a country is the product of the change in the population, technically the change in the amount of the workforce, multiplied by its productivity. And if you have population shrinking, it's really hard to grow. And China's going to have that problem real soon. But nevertheless, I repeat, given its size, its ambition, it's an area, and its political system, it is an area we need to watch very, very carefully. The China-US relationship, if you will, the number one and number two powers in the world, is the most important relationship on this planet, country to country. So we've got to watch it and manage it carefully.
Yeah, thank you. So we're kind of coming down to the final minutes of our hour. So if anybody has questions they haven't put in the chat yet, please do put them in the chat now. I have a question it's a little bit historical, and it's been interesting. We've heard a lot that inflation is at the highest it's been since 1982. So this kind of 40-year high point. And you said earlier that we had the fastest growth since 1984. So in 82, we had really high inflation. In 84, we saw really high economic growth. And we know that, economic business cycles, kind of repeat themselves. Do you think that looking at the 80s, that there is something that we could be thinking or projecting on what's going to happen in these years, like in current times, or is it a totally different, geopolitical situation globally?
Yeah, I think there are more differences than similarities. I mean, history, we know, doesn't repeat itself, but it does rhyme, as they say. I think among the big differences between then and now are, in fact, the forces of disinflation. I mean, I talked about inflation and my cyclical concern, but population and population growth is very disinflationary when it's so low. Technology. I mean, technology has always been a force, but as a percentage of our economy and the global economy, it's bigger than ever. And, as sure as we're talking, there's some new technology coming along that's going to lower the price of something or enable people to do more with the same amount of time. So there's those disinflation, some would argue deflationary forces, I think will keep us from having the kind of inflation for a long period of time that we witnessed back then. And some of us are old enough to remember double-digit inflation. I don't think that's in the cards.
So I'm going to shift a little bit in our final minutes here. And, as a Christian, do you have any advice or thoughts in light of the economy? How should we be responding, in light of the Great Commission, or in light of who we're called to be?
Yeah. So some very practical things. We as Christians need to look at our Creator and since we're created in His image, do things His way. What do I mean by that? Well, God's a worker. Look out the window. If you're unimpressed, call me. It's amazing, God's A+ work. And if we're made in his image, we're to work and we're to be good at our work. So I say to everybody, whatever it is you do, whether you're bringing up kids or working in a grocery store or you're a professor or you're in the investment business like me, do your work well. If you're an A+ at work, people might want to know about the rest of your life and what makes you tick. If you're a C- at work, people, there's Joey over there, not impressive at all. And so that's number one, represent God well because we are his creatures and made in his image. Number two, I think our responsibility, whether we work in a Christian or a secular setting, is, as the Bible says, we're to be salt and light. And the opportunities, we all could spend hours giving testimony to times when we have been salt and light, and sadly, sometimes when we haven't, what a difference it makes. So I just a quick anecdote. I was CEO of a big asset management firm a bunch of years ago, and I purposed two things. One, if somebody asked me about my weekend, which Monday mornings at tip, what did you do this weekend? I would always talk about the things I did that were different from normal, Hannah. And I said, I'm going to say, and I went to church, because I go to church virtually every Sunday. And I'll never forget when one guy asked me 2 Mondays in a row. And when I said I went to church, he said, you went to church last week. Do you always go to church? What a wonderful time to tell why church is important. The other thing was, if somebody came to my office, they did nonstop with a problem, as they left, I would say, can I pray for you? No one ever turned me down. Wonderful time you pray. Lord, give me a chance to share my faith with Sam. And sometimes it doesn't happen. But if Sam's in your office having a problem and he's about to leave and says, can I pray for you? I can talk to my God in front of this guy, Sam. So a couple of little examples. We've got to pick our spots and be his children. And remember, sorry to get on a sermon here, Hannah, that we're on this planet this long and we're in eternity like this long. Put that in perspective.
Yeah, those are some really, really great points. I have one final question. And you said we're on the world this long and it's getting longer. So we have a final question from Dr. Denise Daniels at Wheaton College about your expectations of an aging world population into the next decade. What do you think the implications of that are going to be on investment and finances and the economy?
So the answer to the last question is always buy low, sell high, but I'll amplify it. Look, it's a serious issue. Thriving economies tend to have decent birth rates. And when birth rates go below replacement, which increasing number of companies, we in the US are not too far from it. Half of Europe is there, and the parts of Europe that are below replacement tend to be the poorer and more struggling parts of Europe. So it does mean a slower growth. The population of the planet will peak if these birth rates don't change. Now, there are other parts of the world, Africa in particular, where there are prolific birth rates, and we need to get the education to match that in some ways. But the implications for the globe are serious, and growth will be dampened. And look, when a country or the world or a business is growing, people thrive. When it's not, it's a lot more difficult.
Yeah, well, that is definitely something that we'll be watching for in the future. And robotics, AI, maybe that'll help us out as we see those things shift. So they'll be a lot more important. Well, Bob, thank you so much for sharing these forecasts with us and your predictions. It's both encouraging. I loved hearing the words and the advice you had around, especially values-based and the way that we can be salt and light in the marketplace. And I really appreciate the work that you do to think and put this information out there. So on behalf of everybody on the call and CFI, and thank you, Tommy, for helping to organize this. Bob, thank you so much for your time today.
My privilege. Don't forget, only he knows the future.
Amen. All right. Well, thank you so much, and we'll hope to see you soon.